In early 2024, gold broke out of a 13-year basing pattern that had been developing from 2011. Since then, gold has been one of the best performing financial assets. Just over the last 12 months, gold has risen by over 35%, and that number jumps to 60% when we look at gold's performance since the October 2022 bottom. Many investors speculate that this strength on gold is warning of an impending U.S. debt crisis. Renowned investor Ray Dalio, for instance, believes that investors should be buying gold to protect themselves against a possible debt crisis in the U.S. Gold is an asset that is in direct competition with U.S. Treasury bonds, so U.S. government debt. Both of these have historically served as safe haven assets to hedge portfolio risk and diversify investors away from stocks. Traditionally, investors have chosen Treasury bonds as the go-to investment, as these provide a steady return on investment through their interest payments. However, the performance of Treasury bonds since 2020 has been devastating. The ETF that tracks the price of U.S. Treasury bonds, called TLT, has fallen by 37%, dragging down the portfolio performance of any investor choosing it as a hedge. In the meantime, gold has provided a very strong return, moving up by 80% over the same period of time. So it's a fair question to ask whether this dynamic that we're seeing develop between these two competing assets is hinting at an incoming U.S. debt crisis. Indeed, we can make the case that Treasury bond prices have been under pressure simply because the U.S. government's solvency has started to come into question. Let's not forget, holders of U.S. Treasury bonds are holders of U.S. government debt, and U.S. government debt levels have been soaring. This is a chart of the total public debt in the U.S. It shows the total amount of money the U.S. government owes creditors, including individuals, businesses, and foreign governments. At the beginning of 2020, prior to the pandemic, U.S. total debt was at $23.2 trillion. Fast forward to the third quarter of 2024, and the U.S. government owes almost $35.5 trillion. If we add a chart of U.S. GDP on top, so economic growth in the United States, it's pretty clear that GDP hasn't been able to keep up with this sharp rise in U.S. debt. And GDP is key because this directly affects the taxes that are collected by the U.S. government that helps them pay back the debt. So higher GDP typically leads to higher taxes as the economy booms, and vice versa. Since the 1960s, U.S. GDP has systematically remained above U.S. debt. That is until 2015, when U.S. debt crossed GDP for the first time in history. Ever since, this gap has only gotten larger, meaning the ratio of debt to GDP has gotten bigger. Numerous academic studies show that a high debt to GDP ratio signals greater financial risk for a country, making it harder for governments to repay their debts. This can lead to lower credit ratings as lenders view the government as less creditworthy. As a result, the government faces higher interest rates on borrowing, increasing the cost of servicing its debt that could eventually also risk a default. So the concerns on Treasury bonds do seem valid, and this is directly benefiting gold as investors have been shifting their portfolio allocation from Treasuries to gold. The question now is whether this is a trend that is going to continue over the coming months. We can assess this by looking at this chart of U.S. government spending going back to the early 2000s. It shows us when the government has ramped up its expenses and when it has gone through periods where it tries to cut spending, also known as austerity. Recently, government spending has been ramping up, and that has likely exacerbated the concerns around U.S. government debt. In fact, if we plot the relative performance of gold against TLT, the Treasury bond ETF, on top of this chart of government spending, we see that the two are very closely correlated. As government spending ramps up, gold outperforms TLT, and as government spending starts to decline, gold underperforms Treasuries. For instance, in the early 2000s, government spending rose rapidly, leading gold to outperform Treasuries. That was until 2010, when government spending turned back around and declined quite significantly. This put downward pressure on the gold to Treasury ratio. Since then, we've consistently seen government spending increase, resulting in a consistent outperformance of gold. So the recent ramp up in government expenses has undoubtedly contributed to the poor performance of Treasury bonds against gold. The question now is whether we're going to see a continuation of government expenses, or are we about to see a reversal as the U.S. government finally attempts to keep its expenses in check? One of Donald Trump's key goals is to reduce U.S. government spending. One of the ways he plans to achieve that reduction is by establishing the Department of Government Efficiency, DOGE for short. The goal of DOGE will be to identify and remove unnecessary government expenditures, streamline federal agencies, and cut ineffective government programs. Trump also plans to implement a federal hiring freeze and consolidate over 400 federal agencies into approximately 99, aiming to decrease the federal workforce and reduce administrative costs. Only time will tell if these measures prove effective. If they do, it's possible that it does turn government spending around, and that could put an end to gold's outperformance against Treasuries. However, the road to cutting U.S. government spending might not be as straightforward as it seems. Around 30% of total government spending comes from just healthcare. Back in 2009, the U.S. government spending on healthcare was about 5% of the entire U.S. GDP. Right now, that number sits at almost 6%, and healthcare costs are expected to continue growing for the next 30 years, potentially even crossing 8% of U.S. GDP, according to the Congressional Budget Office, an agency that provides Congress with economic and budget analysis to help guide policy decisions. The reason healthcare spending is projected to increase is in large part because of an aging population in the United States and the spread of chronic diseases like obesity and diabetes. These are problems that require much more complex solutions. The US government won't be able to just cut spending for them. And the same is true for interest costs. So the interest payment on US debt, that is also largely out of the control of the US government. These are also projected to grow from 3% to 6% of GDP. Another factor to consider is defense spending. Defense spending in the US makes up a massive 13.3% of federal spending. And in a world with ongoing global conflicts and rising geopolitical tensions, it's possible that the government ramps up its spending on defense. For example, ever since Russia invaded Ukraine in February of 2022, the US has already sent $66.5 billion worth of weapons. So, although the new administration seems to be determined to reduce government expenses, they may find the task to be difficult. Certain areas of federal spending like healthcare, interest costs, and defense spending will prove tricky to cut down on, and together make up over 50% of government spending. If they are able to reduce spending, and that's a big if, it could lead investors rotating into Treasuries from gold. But if government spending continues like it has been over the past years, it would likely lead to a secular outperformance of gold. In fact, gold has shown to be quite a reliable way of judging how the market is thinking about the US debt situation, and its recent recovery indicates that the market continues to remain concerned about the US debt, at least for now. At Capital.com, we'll continue to provide updates on such market developments. You can trade the TLT ETF and CFDs on gold on the Capital.com platform. Thank you for watching.